Hi everyone, Joe Gentile from Left Tail Risk Advisors. In this video, I want to talk about an area of life insurance where I would suggest a lot of caution, and that is with premium financing. And that is particularly with premium financing of index universal life insurance policies. So I'm going to start with the punchline. The punchline is that insurance is meant to be a risk mitigation tool. And any strategy that involves the strategy only working when assumptions are favorable is not a risk mitigation strategy. It's speculation strategy. And I think premium financing with IUL is really a speculation strategy, and it is not a risk mitigation strategy. So the strategy is pretty simple, attractively simple, and that is you can get large amounts of life insurance with very low out-of-pocket outlays by borrowing the premium payments from a bank. That's pretty much what premium finance is. You're getting a large life insurance policy typically, and you're funding the premium payments with loans from a bank. And in order for this strategy to work, you basically need to have this arbitrage situation where the crediting in the policy is greater than the interest rate that the bank is loaning you money at. And this can be true, and it has been true for relatively short periods of time, where the returns on the policies, particularly during a low interest rate environment, where the returns on the policies or crediting in the policies has outpaced um, the interest rate on the loans. But you have to remember that life insurance is a long-term play. You're going to hold these policies for life. It takes a long time for enough cash to be generated in the policies to pay off the loans. So you need a long period of time where pretty consistently you're going to have the crediting on the policy outpace the interest rates on loans. Honestly, I don't think it is possible, but is probably not likely for most scenarios where that is going to play out. And that's borne out in the recent past, where we've had large spikes in interest rates in the last few years. And that's compounded by the fact that a lot of index universal life insurance is now sold using proprietary indexes. And these proprietary indexes frequently underperform when interest rates are increasing. So you get a double whammy of your crediting rate going down while interest rates are increasing and your borrowing costs going up. And so this can create situations where collateral calls happen. And so now all of a sudden, what was looking like a strategy that wasn't requiring a lot of capital, now it's going to be a pretty capital intensive strategy. And to further compound that, a lot of premium financing strategies were sold to people for which it was not really appropriate. There is a group of people that this is appropriate for. So if you have the ability to fund this life insurance policy on your own without the financing and it's not going to hurt you, but you'd rather put the money towards other investments that you think you can get a higher return on, then maybe it makes sense to premium finance because it does free up capital to do other investments. But there's a lot of people, most people that were put into premium finance deals, this was not their scenario. There were a lot of people that were put into premium finance that had, I would say, not modest net worths, but net worths below $5 million. And the premium payments, if they were not financed, there is no way they could afford it out of current income. For these folks, these strategies are a catastrophe. It's a real problem, and it just creates just these really bad situations that could eventually just really just derail their entire financial lives. So I would say this, if you are looking at a premium financing deal and it's being presented to you in a way that's very rosy, make sure you really understand all the risks that are involved with this strategy. What happens if the rosy assumptions that you're given don't play out? Can you still afford the policy? So I would give a lot of thought to that because there's a lot of folks that were put into these policies who couldn't afford, what happened if negative assumptions turned out to be accurate, not rosy ones. Be very cautious. If you already have one of these policies, you really want to have this reviewed by somebody other than the person that sold it to you. Get an independent third party to review it. This way you have your arms around what the risks actually are for you. And if there are a lot of risks that you didn't realize that are embedded in this, it's better to find that out early rather than find that out late. If you find it out early, there may be ways to unwind the deal or get a more appropriate policy or change the financing, or in the worst case scenario, to file a lawsuit. So, again, I'm also an attorney. We represent policyholders for life insurance deals that go poorly. One thing to keep in mind is, depending on the state you're in, statute of limitations could be short. If you were misled into one of these strategies and it cost you a lot of money, if there is a legal solution, you're better off trying to pursue that legal solution sooner rather than later because of statute of limitations concerns. So if you have any questions on this, please feel free to reach out. It's an area where, unfortunately, I think a lot of people got hurt or in the process of getting hurt. So if you thought this video was helpful, or you want more information on premium financing and just generally what to do if you're already in one of these situations, either from a legal perspective or just from a what are my other options with a policy perspective, please feel free to reach out for that. And I encourage you to like and subscribe for future videos on the topic. Thanks.